The US-China trade war has entered a dangerous new phase. Gone are the days of mere tariff skirmishes. Today the battleground has expanded, engulfing global currencies, supply chains, and even the daily lives of ordinary citizens. This latest escalation is fueled by a fundamental clash of economic ideologies. The US, under the current administration, seeks to reassert its dominance, employing protectionist measures to shield domestic industries. China, meanwhile, is determined to solidify its position as a global economic powerhouse, challenging the existing world order. This struggle for economic supremacy has far-reaching consequences. The stakes are high, not only for the US and China, but for the entire global economy. As tensions rise and retaliatory measures multiply, the world watches with bated breath, bracing for the impact. In a strategic move that sent shockwaves through global markets, Chinese exporters have begun offloading their US dollar reserves. This calculated maneuver is a direct response to the escalating trade war and the weaponization of the dollar's dominance. By converting their dollar holdings into yuan, Chinese companies aim to weaken the US currency. This tactic, if successful, could have significant implications for the US economy, potentially leading to higher inflation and increased borrowing costs. This dollar dump is a clear signal from Beijing. China is prepared to utilize its considerable financial firepower to defend its interests. The move highlights the high-stakes nature of this economic conflict and the willingness of both sides to deploy unconventional weapons. Adding fuel to the fire, prominent U.S. investor Scott Bessent recently issued a stark ultimatum to Beijing. Bessent, known for his bold pronouncements, demanded that China take the first step in de-escalating the trade war. Failure to do so, he warned, would be met with even more aggressive measures from the U.S. Bessent's stance reflects a growing sentiment within certain U.S. circles. This faction believes that China is more reliant on the U.S. market than vice versa, giving the U.S. greater leverage in this economic standoff. However, this assumption is not without its critics. Some analysts argue that China has diversified its economy, reducing its dependence on the U.S. market. They warn that Bessent's hardline approach could backfire, leading to a prolonged and damaging trade war. The impact of the escalating trade war is already being felt across the U.S. economy, most notably at the nation's bustling ports. The imposition of a staggering 245% tariff on certain Chinese goods has triggered a wave of import cancellations, throwing the intricate machinery of global trade into disarray. U.S. ports, once teeming with activity, are now grappling with a sharp decline in traffic. Shipping containers, once symbols of global commerce, now sit idle, their contents caught in the crossfire of this economic conflict. This slowdown in port activity is a stark visual representation of the trade war's real-world consequences. It serves as a stark reminder that the global economy is intricately interconnected, and disruptions in one area can have ripple effects across the entire system. Section 5. Empty shelves, rising prices, the consumer's burden. The trade war's impact is not limited to boardrooms and shipping lanes. Ordinary American consumers are also feeling the pinch. As tariffs bite and supply chains buckle, shoppers are confronted with empty shelves and rising prices. Basic necessities, once taken for granted, are becoming increasingly expensive. From groceries to electronics, the cost of living is steadily creeping upwards, putting a strain on household budgets. This inflationary pressure is exacerbating an already precarious situation for many Americans. With wages stagnant and the social safety net fraying, the trade war's economic fallout is disproportionately impacting the most vulnerable segments of society. In a move that has sent chills down the spines of global leaders, the White House has begun floating the possibility of imposing full-blown embargoes on certain Chinese goods. This drastic measure, if enacted, would represent a significant escalation of the trade war, with potentially catastrophic consequences. An embargo on Chinese goods would have far-reaching implications, disrupting global supply chains and depriving U.S. businesses and consumers of essential products. It would also likely provoke a swift and forceful response from Beijing, potentially triggering a downward spiral into a full-blown trade war. The threat of an embargo is a dangerous gamble, one that could have unintended and unpredictable consequences. It underscores the high-stakes nature of this economic conflict and the willingness of both sides to push boundaries in pursuit of their objectives. The US-China trade war is not a localized skirmish. It is a global conflict with far-reaching implications for the entire world economy. As tariffs rise and trade barriers proliferate, The intricate web of global supply chains is being severely disrupted. Companies around the world are struggling to adapt to this new reality, finding alternative suppliers, navigating complex trade regulations, and absorbing increased costs are just some of the challenges they face. This disruption to global supply chains is having a ripple effect across the global economy. Businesses are facing delays, shortages, and increased costs. Consumers are experiencing higher prices and reduced choices. The longer the trade war drags on, the more severe these disruptions will become. The escalating trade war is not only impacting the flow of goods and services, it is also sending shockwaves through the global financial system. Nowhere is this more evident than in the bond market, where investors are increasingly nervous about the economic outlook. The yield on the 10-year U.S. Treasury note, a key benchmark for global interest rates, has spiked in recent weeks, reflecting growing concerns about the trade war's impact on economic growth and inflation. This volatility in the bond market is a worrying sign. It suggests that investors are losing confidence in the ability of policymakers to manage the trade war and its economic fallout. If this trend continues, it could have severe consequences for global financial markets. The US-China trade war is more than just a dispute over tariffs and trade imbalances. It is a symptom of a much deeper schism, a fundamental realignment of the global economic order. The post-World War II era of US economic hegemony is drawing to a close, and a new, more multipolar world is emerging. This new world order is characterized by increased competition, shifting alliances, and a diffusion of economic power. China is challenging the US for global economic leadership, while other regional powers are asserting their own interests. This transition to a new economic order will be fraught with challenges. The risk of miscalculation, misunderstanding, and conflict is high. The world is entering uncharted territory and the stakes have never been higher.